Welcome back. This is Retirement News Online from our beautiful studios in beautiful city, Scottsdale, Arizona. As more retirees accumulate significant assets outside of qualified plans, the role of the financial advisor has evolved beyond traditional retirement income strategies, from managing capital gains exposure to optimizing withdrawal strategies. Now, it's important to rethink how these assets fit into a sustainable and flexible retirement plan. Joining us once again, Jeff Crawford with HBW Advisory Services in Eagle, Idaho. So when clients come to you with these large non-qualified accounts, in other words, it's not something that like a 401k. They're non-qualified, the taxes have not been deferred. What are the first key risks or opportunities that you have to evaluate?
Yeah, good question. We're seeing a larger number of clients coming to us with non-qualified assets, significant non-qualified assets, whether it's from leftover funds selling a home someplace and coming to Idaho to buy a home, pay cash, and have several $100,000 left over, or wherever the money comes from. And one of those big concerns is, where do I put this lump sum of money where I'm not going to get heavily taxed on it every year? So you need to, an advisor needs to be very careful about selecting investment choices that are tax efficient. We want the money to grow. At the same time, I want to minimize my taxes. So it narrows the choices of where to put that money. So we look at lots of different products. One of those are annuities. Annuity is a bad word for a lot of advisors or people, but there are some tremendous advantages for the right client for a portion of their assets to be protected in a tax-sheltered annuity. Or another strategy we like is setting money aside into a direct indexing account where we can capitalize on market fluctuations, and we can bank those temporary short-term losses on those account balances, so that at the end of the year, if the account grew by $20,000 but we captured $10,000 in losses, well, now you're only reporting taxes on $10,000 instead of $20,000. So that's another strategy.
So, I mean, so non-qualified assets, how do they fit into a broader legacy or like estate plan for clients?
Exactly. Well, they fit very well in estate planning issues. One client in particular I can just mention the highlights of. We had a significant, several $1 million of non-qualified money, and we were able to set that portion of that money aside in that tax-sheltered account. And they now have $8 million in gains that they've never paid taxes on. And it's part of a very sophisticated estate plan with an estate planning attorney. And the attorney, the client, the beneficiaries, everyone's loving in that tax strategy. And so that's one that comes to mind. But there's several other tax efficient strategies to shelter funds or minimize the taxes on the gains that we utilize.
What are some, like a good example of a common mistake, you know, because they're not working with you, a common mistake that someone would make with a large non-qualified account?
I would say probably the number one I see is investing it all in stocks, mutual funds, non-qualified, taking all of the taxable gain. Maybe they're doing short-term trading or creating some short-term capital gains, which are going to be taxed at a higher tax rate than they would on long-term capital gains. So those are probably the most common mistakes we see, is just investing without also wearing that tax hat to analyze the whole picture.
Doesn't everybody do aggressive tax planning?
You'd think so.
No.
But they don't.
They don't. Well,
yes.
We appreciate you being here. Jeff Crawford with HBW Advisory Services in Eagle, Idaho. This is Retirement News Online. If you'd like to find out more about us and Jeff and anything else, go to retirementnewsonline.com. Thank you for watching.